Welcome to vTalkInsight, Risk Sentiment Daily for April 6, 2026. Strong U.S. data is colliding with one of the sharpest energy supply shocks in decades, leaving risk appetite fragile and highly selective. Let's look at how that tension is shaping today's defensive tone across major asset classes. Across assets, the balance of evidence points to an overall risk sentiment that is best described as a defensive risk-off tilt. Volatility remains elevated, and the dominant narrative has shifted back to energy and geopolitical risk, even though U.S. economic data continue to surprise on the upside. After a brief rebound earlier in the week, investors have been trimming exposure again as Middle East headlines and oil prices move back to center stage. The main reason for this caution is that the Middle East energy shock now feels less like a short-lived scare and more like a sustained supply event. Spot crude and refined products are trading at levels not seen since the late 2000s, physical shortages are acute, and emergency stockpiles are being drawn down at a pace that could force difficult choices within a few months. That backdrop is driving de-risking in equities and credit, particularly in regions and sectors most exposed to imported energy. At the same time, robust U.S. payrolls, retail sales, and purchasing manager data are providing a cushion, especially for U.S.-centric assets. However, the reaction function is asymmetric. Strong data have pushed Treasury yields a little higher and weighed on equities, as markets worry more about policies staying tight than about recession in the near term. So the current state of play is a growth-supported but volatility-prone environment, where the downside tails from energy and policy uncertainty keep portfolios skewed toward defense. The most powerful bearish driver right now is the Middle East energy shock and the associated supply hit. Physical benchmarks such as dated Brent have surged above $140, with some cargoes clearing above $150, and West Texas crude has jumped by double digits in a single session. Refined products are even more stressed, with diesel and jet fuel in Asia reportedly trading above $250 a barrel, underscoring how tight end-user supply has become. This is not just about headline prices. It is about logistics and availability. Attacks on Gulf infrastructure, tighter Iranian control over the Strait of Hormuz, and new protocols and tolls are disrupting normal shipping patterns and leaving tanker capacity scarce. Freight costs of $10 to $20 a barrel are restricting U.S. exports, building inventories domestically while importers in Europe and Asia struggle to secure barrels, and OECD emergency stockpiles are projected to fall by around 1 billion barrels in as little as 2 to 3 months. The macro fallout from this energy shock is highly uneven. Energy importers in Southeast Asia and parts of Europe face meaningful downside to GDP, while energy producers and related equities are clear relative winners, reinforcing a sharp rotation in global leadership. Policy responses, from strategic reserve releases to regulatory waivers, can smooth the path, but do not fully offset the supply hole, so the key watch points are the security of Gulf infrastructure, volumes through Hormuz, and whether rationing measures in Europe and Asia need to be escalated. Layered on top of the energy shock is rising concern about stagflation risk and higher-for-longer policy. Persistent supply disruptions are expected to lift headline inflation by roughly 0.7 of a percentage point, and core inflation is now projected to hover near 3% for several quarters as energy costs bleed into broader prices. That combination of sticky inflation and slowing real income growth is a classic stagflationary mix, and it materially limits how quickly central banks can pivot. Several analyses now argue that persistent economic strength, together with repeated energy shocks, could keep inflation close to 3% and delay meaningful rate cuts well into 2027. Market commentary highlights that central banks are wary of easing into a supply shock, given the risk that inflation expectations become unanchored, and this is feeding a narrative of selling into rallies in risk assets rather than buying dips. Investors are increasingly worried about an environment where discount rates stay high while growth outside the United States slows, which is a difficult backdrop for long-duration equities and leveraged capital structures. There are important counterpoints that could limit the stagflation story. Wage growth has cooled, with average hourly earnings slowing to around 3.5% year-over-year and monthly gains at their weakest since December, and underlying labor indicators such as hours worked point to softer discretionary income rather than overheating demand. Some investors therefore see a path where, if growth momentum fades and unemployment edges higher over the summer, central banks gain room to cut. But until that inflection is clearer, the policy bias is being read as higher for longer. A third bearish driver is emerging credit stress and a broader shift toward risk-off positioning. Private credit funds are seeing redemption pressure and gating in places, and high-yield and leveraged loan spreads are flagged as vulnerable to further widening if current uncertainties persist. At the same time, there is a sense that credit spreads remain too tight relative to underlying macro risks, and that some of the recent tightening has been driven more by technical flows than by fundamentals. Positioning data and client flows echo this caution. Investment strategies are tilting toward high-quality government bonds and income-oriented value equities, while survey evidence shows a clear bias toward expecting lower long-term yields as growth risks build. That rotation reflects rising concern about a growth shock rather than an inflation shock, even as headline inflation stays elevated, and it underscores the risk that spread products tied to weaker issuers or illiquid structures could face further pressure. Importantly, today's credit story is still a shakeout, not a systemic crisis. Commentary notes that ample capital remains available for stronger borrowers, and high-quality credits with solid coverage ratios are holding up relatively well, which helps contain contagion risk. For multi-asset portfolios, the key is that risk premia in lower quality credit and parts of private markets may need to reprice higher from here, especially if energy stays expensive and growth outside the U.S. disappoints. On the supportive side, resilient U.S. growth and labor data remain a major bullish counterweight. March non-farm payrolls beat expectations decisively, adding around 178,000 jobs versus estimates near 65,000, and the unemployment rate fell into the low 4% range. Beyond a single report, recent readings on retail sales, jobless claims, and business surveys have also surprised positively, pushing economic surprise indices to their highest levels since late 2023. This pattern points toward a soft landing narrative rather than an imminent recession, and it helps explain why corporate activity, including mergers, acquisitions, and planned initial public offerings, is accelerating. Executives appear to be leaning into the idea that AI investment, industrial policy, and supportive tax measures are driving a domestic growth impulse that can withstand higher energy prices, at least near term. However, the quality of growth matters. Aggregate income growth in March was close to zero, labor force participation has slipped, and excluding healthcare, job gains over the past year look much weaker, suggesting that the strength is not evenly distributed. For markets, this resilience underpins earnings expectations for U.S.-centric sectors and supports the view that any growth scare is more likely to be imported via higher energy costs than generated domestically. It also reinforces the divergence between the United States and more energy-dependent economies, with U.S. assets perceived as a relative safe harbor despite higher policy rates. The risk to this driver would be a clear turn in high-frequency labor indicators or evidence of broad demand destruction, which are not yet visible in the headline data, but remain key watch points. A second bullish driver is structural AI and capital market strength, which continues to support risk-taking even in a choppy macro tape. Companies are increasingly directing budgets toward AI investments and the broader U.S. industrial renaissance, trends that are seen as driven by long-term technological and political forces rather than by the precise level of interest rates. This is creating a durable capital expenditure cycle around semiconductors, cloud infrastructure, and critical supply chains that can persist through periods of monetary tightening. Capital markets reflect this optimism. Global merger and acquisition activity is described as running at record levels, and the pipeline includes several mega initial public offerings in high-profile AI and space names, signaling strong investor appetite despite elevated volatility. Venture and private equity flows into AI-related businesses also highlight that, beneath the surface caution, there is still a powerful bid for growth and innovation themes. There are, however, side effects and risks around this AI-driven boom. Some evidence suggests that the shift of corporate budgets toward automation and digital investment may be contributing to restrained hiring and job cuts in other areas, and it increases dispersion between winners and laggards in both equity and labor markets. For portfolios, that means the AI and industrial story is a genuine medium-term support, but performance is likely to remain highly concentrated and sensitive to any sign that growth or regulatory momentum is stalling. The third supportive driver is the prospect of future Federal Reserve easing, even if the timing is now more contested. Subdued wage growth and stable, though gradually loosening, labor conditions reduce the risk of a wage price spiral, giving the Fed scope to stay patient rather than retightening aggressively. Several views suggest that if oil-driven shocks persist and financial conditions tighten further, rate cuts later this year or over the following 1 to 2 years remain plausible. This has clear market implications. High-quality government bonds are increasingly seen as attractive long-term holdings, with investors adding duration in anticipation of lower yields over a multi-year horizon, and survey data show a strong consensus that 10-year Treasury yields eventually move lower as growth risks build. Against that, there are structural headwinds, including weaker foreign demand for treasuries as governments prioritize domestic infrastructure and defense spending, and the possibility that persistent inflation delays meaningful cuts until much later, which would challenge any aggressive duration stance. The upshot is that the Fed is likely to maintain a wait-and-see stance while energy and geopolitical uncertainty remain high, keeping policy options open in both directions. That makes incoming data on inflation, wages, and labor market slack critical not only for the direction of yields, but also for the correlation between stocks and bonds, which has been unhelpfully positive in recent inflationary episodes. For risk sentiment, the perception that policy easing is delayed rather than canceled helps explain why investors are defensive today, but not in full capitulation. To sum up, today's risk backdrop is shaped by a powerful clash between a severe Middle East energy shock and still resilient U.S. growth, with central banks caught in the middle. Energy-driven stagflation risks and emerging credit stress are keeping portfolios defensively positioned, even as structural AI investment, active capital markets, and the prospect of future Fed easing offer important support. Watch the trajectory of oil supplies, labor data revisions, and policy signals in the weeks ahead, because shifts in any one of these could quickly reprice equities, credit, and duration. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.